The Money Show. Personal finance.
Our personal finance feature, Warren Ingram, personal finance advisor and executive director at Galileo Capital, joining us. It's been an interesting week, of course, a week and a half, really, if anything. Trump, Brexit, in the last the last year. Pravin Gordon's axing, of course, last Thursday. S&P's downgrade on Monday. It all culminates, in fact, in a whole lot of weakness in the local market as well, doesn't it, Warren?
Absolutely, Arabella. And I think the big issue, I mean, when you say interesting, I think it's the Chinese curse. Eh? It's not. This isn't fun interesting. This is lousy interesting. It's actually exhausting. And so I think we sit in a situation now as investors looking at this, and hopefully we've learned a little bit from Nenegate, that we need to try and be rational. And
well, the markets certainly haven't they? I mean, they haven't blown out entirely, particularly the Rand.
You're right.
In where it stands.
And I think that's interesting to me, because I think I always think there are three major drivers of the Rand. So the first one is international factors, and then the second one will be when I say international factors, it's international economic news.
Yeah.
And then the second one will be the resources cycle, whether it's going up or down, and the third factor is the domestic politics.
Yeah.
So at the moment, 2 out of the 3 are actually in our favor. So the international economy looks okay. I'm not saying it looks fantastic, but it looks okay. The resources cycle looks like it's continuing to pick up. So that's why the Rand's actually a lot stronger now than it was in the Nenegate issue. In the Nenegate issue, we actually had all 3 factors working against us.
Yeah.
So I agree with you that the Rand hasn't blown out, but what I would be saying is actually we'd probably by now be below 12 to the dollar if we didn't have the politics.
Oh, how we really wanted those good times, didn't we?
So we're there, and unfortunately now we need to say, what's the new world look like, and how do we make rational decisions? So I think a couple of things. One, it's very important to distinguish between the economy and the stock market. No doubt in my mind that the economy is in for a heck of a hard time now. We've got tough times coming up. Interest rates are most certainly going to go up if inflation goes up. Inflation goes up if the Rand weakens. And the Rand's weakened. Yeah. And if the Rand stays weak, then we're going to get imported inflation, because most of what we consume in this country is imported.
Yeah.
And so who does that hit the most? It unfortunately hits the people who can afford at least the poorest of our country, because for them, things like transport costs make up a huge proportion of their monthly expenses, and if the fuel price goes up in rands, that's going to affect them. So I think we're going to be in a situation where the economy is going to really struggle. The growth rate's definitely going to slow. Unemployment's going to go up even more, and the cost of funding goes up, which means the interest rates go up. So all round bad news, and intuitively we would be sitting there saying to ourselves, well, that must be bad for the stock markets. So it's worth just understanding what happens to other countries that get downgraded, and their stock markets and their currency markets in the 12 months.
Particularly in the aftermath, right? Yeah.
Exactly. I mean, what happens in the first few weeks or even the first 3 or 4 months, to me, is going to be noise. So we need to look through the noise, because we can't predict what's going to happen next week.
Yeah.
But what we can do is look at the other countries and then say, well, over 12 months, maybe logic starts to apply. And what seems to happen is their stock markets go up, and their currency actually strengthens.
Finally, some good news.
So, well, it's good news if we follow the same trend. And usually what happens is action gets taken to rectify whatever caused the downgrade. And if you look at our situation, a couple of things were going right. Our trade deficit was looking better. The economy was looking like it was sort of finding its feet again. Business and government were cooperating. And then this happens, and it's pretty much down to politics. So unfortunately, I don't think if we have a political switch that it's suddenly going to cause our downgrades to be reversed quickly. That's going to take time. But from an investment point of view, you would look at this and you'd say, well, there's every chance that we find major bargains in our stock markets now. I think the banking sector, to me, looks like a really great value, and so you've got to be rational about that and say, well, not our whole market is not suddenly worthless, and that's important to start looking at buying opportunities, and then to say, well, if we look through this, if the Rand does continue to weaken, that's massively positive for the Rand hedge shares, and Rand hedge shares make up more than half of our stock market by value. So if we look at those companies, the likelihood is, even if they don't do well in international markets, in dollar terms or pound terms or euro terms, they might do very well in Rand terms, because the Rand weakens and their price goes up.
Yeah.
And I think we saw that already starting at the end of last week.
Yeah.
So I think there's there's a strong likelihood to me that if the economy goes bad, that the stock market still does well, and if we see resolution, if we see all the actions that we need to take place actually start happening to turn the economy around, then the stock market's going to anticipate that as well, which means that we might end up with a double kick going forward.
Sure.
So I just don't see doom and gloom from an investment point of view necessarily, like I see economic gloom, and I'm not shying away from that. We've got major problems that I think are only going to get worse unless we see a resolution.
Sounding very bullish there's Warren Ingram this evening, and I like that. I must say I like that. 31702, 31567 as well. Those are our SMS lines. Do send through your questions. You can also call in 011-883-0702 or 021-446-0567. We have a question from Johan, and he says, is this not the time to buy bank shares? I mean, they've fallen quite a bit, at least around 11%, I think, since the reshuffle itself, 15% since last Monday. Is this the time to buy bank shares?
I think you have to look at them as a great buying opportunity, and just if you look at the average dividend that they're paying, the dividend yield now, based on the current share prices, they're looking at well over 5%, some of them over 7% now, and if we think that you put cash on deposit at a bank and you're probably getting around 7.5%, 8%, and if you're really lucky, 8.5%, which is all taxable, then getting a dividend yield of 6%, as for argument's sake, with the prospect that dividend yield might grow if those banks continue to generate some sort of profit, tells you that there's great value there. I mean, that relative to some of our other businesses and other sectors in our market, we know our banks are extremely well managed, and so they will adapt to the current environment and go. So to me, I think that is a good value sector, and I think there are going to be a lot of businesses like that now in our market that have just been sold in sheer panic.
Yeah.
And take your time and you look around. I think this is the time for people to be running into the burning building to get those bargains. Don't run out now. Look around.
Yeah. So don't rush out. I mean, don't be rash about making your decision. Perhaps, like you said, look through the noise.
Yeah. And I think, the other question that I'm getting a lot is about, do we now send our money overseas because,
yes,
they're going to reverse exchange controls, they're going to, nationalize our pensions, they're going to do all these things. Well, I mean, given what's happened in the last couple of weeks, you can't say never. That those things are never going to happen. But for now, I think, there are many more warning signs that will come up before those decisions will be taken. So to me, looking at the offshore investment discussion, I've been very comfortable to increase my overseas allocation when the rand was at 13 rand 50 to the dollar or stronger, so below 13 rand 50.
Yeah.
So when it's over that, I'm not that excited anymore. I think then I think I'd probably be more patient, and I think there's probably better value looking here. But this is not a trading opportunity. This is a case of saying that's only if you need to increase your offshore allocation, then do that. But right now, I think it's really hard to be, but I think it's time to be patient with your offshore investment decisions.
Patience. What is the outlook for real estate investment trusts, asks Ismail.
So that's a good question, and it follows from one of your earlier interviews about the whole retail sector in general. So a couple of things. One, I think a lot of big offshore companies have listed in South Africa in the real estate sector. So a lot of money's gone there, and it's been really a rand play more so than just buying quality assets over there. I've been quite skeptical of some of those offshore listings that we've seen here, because I just think it's catering to a fashion. People were panicking; they were looking for yield, and they bought property funds overseas that then listed here. So I think that's an issue for me. But if you look at the big retailers or the big REITs that have a huge retail allocation, what's interesting is quality always wins in a battle like this. So if we do see that the whole shopping mall trend that we're seeing in the States does take place here, and I think it's far too early to make that call. But if it does happen, the REITs that own the quality shopping malls, the triple A grade, the ones that we're all going to go to, the big name brands, those are very unlikely to suffer. They'll adapt, and they already have adapted.
They'll find a way. Yeah.
And if you listen to them, they already call themselves entertainment destinations. They're not there just to sell goods anymore. And I think so. So to me, REITs, if retail makes up one sector of that, or one portion of that sector, the other portion would be office space.
Yes.
And if our economy suffers, that's going to be difficult.
Rob in Cape Town has a question for us regarding the downgrade.
Hi, how is it, everyone?
Good, thanks yourself, Rob. Your question?
Yeah, question. With this downgrade, your income funds, which are invested quite largely in bonds how will that be affected by the downgrade? Will the income fund still perform well, or should one stay away from those kind of things? And then secondly, what type of investments should one look at now in terms of like unit trust property, or where do you go? That's my question.
Thanks, Rob.
Okay, in terms of the first question, what we've already seen that the yields on the bonds in South Africa have gone up already. In other words, the price has gone down, and the income has stayed the same. So in other words, if there's a loss, which is usually what the situation will be, that loss has been taken already. The market has already forecast, well, not forecast, but it's already reacted to the downgrade. So I think it's interesting to listen to some of the foreign bond fund managers looking at South African bonds and saying that if they can get a yield on their money, an interest rate of around 9%, they would take it. And so a lot of them are seeing value in our bond market. So I wouldn't shy away from the bond market in its totality, which really leads on to my second point, that if you're looking at investment opportunities now and deciding what to do with your money, very often when the world's so incredibly uncertain, I wouldn't say you take out a dartboard and start throwing a dartboard at the investment market to try and make decisions, but what you do is you spread your risks across every kind of diversification that you can. In other words, you spread across cash, bonds, property, and shares. You spread it across local versus international as well. And then you spread it out over time. In other words, if you're sitting on a lump sum of money now that you would like to invest, don't go and invest it all tomorrow in the asset allocation. What you do is you spread it out over time. So you would say, there's immense uncertainty in this market. So I'm going to take, if it's a large lump sum and it's an important amount in your life, spread it out over 6 or 12 months.
Yeah.
So that you at least diversify the political volatility as well, because that might work in your favor, it might work against you. But as soon as you spread it out, you're going to manage your risks. So I would say that you're diversifying across every kind of asset class you possibly can, and the local international. So in the typical space, to answer the question in a long-winded way, you eventually get to a typical balanced fund, for example. That would be, in the unit trust world, what you should be looking at.
Yeah. Warren Ingram is a personal finance advisor and executive director at Galileo Capital. As we were talking personal finance, of course, this segment always gets people riled up and wanting to know more. But Warren, thank you so much for the time. Hopefully we'll chat again. We should do this more often, perhaps a little longer as well sometimes.
Look forward to it.